Let's start with some of the big news on the economy this week, which is consumer spending in the United States. It is softening, clearly. Also, consumer confidence is down. There are those who say that means maybe the Fed doesn't need to hike as much, maybe even may get to cuts sooner than we thought. What do you think about consumer spending right now?
Look, I think we're seeing that inflation, which has eroded people's purchasing power, the end of the fiscal stimulus that gave people a lot of cash last year, higher interest rates that are discouraging housing and housing-allied kinds of spending, generalized increases in uncertainty and just a bit more feeling of insecurity. All of that is taking a toll on spending. My guess is that that's going to continue for some time, and I think you'd have to say that whatever you thought about recession risks a month ago, the recession risks through the year 2022 have to have gone up in a quite material way. I've felt for a long time, as you know, David, that we're not going to have inflation return near target without a significant economic downturn. But that downturn could happen either because interest rates set by the Fed rise very, very sharply, or it could happen because of a kind of self-fulfilling process coming out of the high inflation and reductions in people's incomes. And the latter possibility is looking more likely today than it was. And of course, if the economy did go into recession in the next 6 to 9 months, then you'd probably see a reduction in inflationary pressures, and you'd see the Fed probably feel that it had to push rates up less than it would if the economy was continuing to grow strongly and labor was, and there was very, very strong demand pushing up wages and prices.
So, Larry, I just want to be very precise here because you and I have talked quite a bit about the likelihood of recession this year and next. And you've said next year you think it's much more likely than that. But thus far, you've said this year maybe not so much. Are you saying, given the data coming in, perhaps a recession or a significant downturn, whether it's a technical recession or not, maybe coming faster than you thought?
Yeah, I think the risks of a 2022 recession are significantly higher than I would have judged 6 or 9 weeks ago. Look, David, we've got the first quarter numbers in the bank. They are negative for GDP. There are many forecasters who believe that the second quarter, which ended yesterday, also had negative GDP growth. It's not really the formal definition of recession, but people often say it's a recession when you have 2 quarters of negative GDP growth in a row. And there's, I think it's probably close to a 50-50 chance, maybe it's a bit less than that, that we've had 2 negative quarters in a row. So I think you have to say that the chance that a recession is ultimately dated as having begun during 2022 has gone up significantly. We've got time yet. The structure of the economy's changed, so I'm not at all confident about it. But I would say the nearer-term risks have certainly gone up. You know, you saw something in reports. It used to be just Target. Now there are reports coming out of other retailers, reports coming out of semiconductors suggesting fairly drastic reductions in demand and fairly substantial buildups in excess inventories, which will then lead to things on sale and will lead to reduced production demand. So those kinds of downturn dynamics are certainly things that are more in evidence than they were.
Larry, one of the things that got us here is obviously inflation and the question of supply chain problems. And you've been emphatic that they are not so transitory. Whether transitory or not, Why are they lasting as long as they are? Why aren't we getting more employees in airports and more people flying airplanes and all the things we're seeing around the country? By the way, here in New York, we're having to shut some public pools because we can't find lifeguards.
I think it's a combination of things. We've restricted immigration in various ways relative to where it was. That means fewer people here and working. We've got a variety of problems in terms of reliable production and transportation coming out of China. We have a non-trivial number of people with long COVID and unable to work. There are a larger number of people who want to do jobs where you can work at home. Employers are reluctant to pay what it takes to fill those vacancies quickly because they think it's more profitable to ultimately have some vacancies and turn some people away than it is to raise wages across the board. I think all of these things are contributing factors, and I think with respect to airlines, while a lot of it is on the labor side, there are also some very substantial infrastructure issues that the country is underinvested in for a long time.
And finally, Larry, we had NATO meetings, maybe historic meetings, because they really changed their strategy this week. And I wonder, as we look at the war in Ukraine that Russia has perpetrated there, do you think there may be long-term, really long-term effects on the global economy? Certainly there have been in the short term. What about longer term?
Well, historians will debate whether the Russia-Ukraine war was a cause of big changes or was a consequence of tectonic forces that had been operating for some time. But I was very struck when you had a NATO meeting that for the first time invited a number of countries in Asia to participate in it and identified China as a security risk that had to be prepared for alongside Russia. It did very much have the feeling of a world that was forming blocks and choosing up teams, not unlike, or in some ways, not unlike the alignment that existed in the 50s and the 60s when Russia and China were allied, and there was a mobilization of Western countries along with some Asian countries against them. And that seemed to be a way in which things were moving, and that's going to be a quite different world than the world we've had for the last 25 or 35 years.
Well, Larry, just to follow up on that, you're a great macroeconomist. I am not, but I sort of I thought it was received wisdom that not having blocks was conducive to more growth, more efficiency in the way economies work. And there's a big difference, I think, between the Soviet Union after World War II and China, because Soviet Union was never that large a player, I don't think, economic on the world stage. China's the #2 economy trying to be #1. What does that world look like? Does that really interfere with growth overall?
I think a world in which there are blocks, a world in which countries are kind of forced to choose whose team they are on, is likely to be a world that is both less prosperous. It's a world that's more inflationary because it's going to be harder to find the cheapest products. And it's a world where there's going to be less cooperation on global challenges like climate change or a pandemic.